Citi just cut its first quarter oil price target by $15 to 47. Ed, good to see you.
Good to be with you.
Walk me through the modeling and how you got to 47.
So we got there by looking at what the direct demand impact was on China. We looked at gasoline demand, diesel demand, jet fuel demand, add them all up. We have a base of around 7.4 million barrels a day. We took what I think are some good guesses at what the impact is on all of them, and we came up with, for the immediate period of time, 4 million barrels a day. And we think that's the hit through the first couple of weeks of February. If things start to improve, we think the hit in the last 2 weeks of February will be 2 million a day, and gradually as we get through 2Q, we'll see demand rising. But meanwhile, inventory is building up, and that inventory is going to weigh on prices. There are a whole bunch of other lumpy things at work, but we come to a little bit of a larger cut in demand than the BP CEO did, and a little bit lower price by the end of all of this.
So then I guess the question is, what happens to companies, particularly here in the U.S.? Regina, you're in Houston, so weigh in on sort of what companies do if we get to 47 for 3 months, putting them right at some sort of where they sold some production forward.
Well, we're hoping that we don't get to that, but definitely this is the largest demand destruction event that the industry has faced since the financial crisis. I think that the industry is optimistic that we're seeing some signals that the demand destruction won't be as drastic as what Ed is forecasting, but we don't know yet. I take the fact that the market hasn't overly responded to OPEC's meeting results as an indication that perhaps we're at the peak of where the fear is, and that maybe this is no longer an open-ended risk situation, and perhaps the demand destruction is more closely aligned with what BP's projections are. But at this point, we don't know.
Well, I'm glad you brought up OPEC, Ed, because how much would OPEC have to cut to sort of either stabilize prices, not get to 47? What do you think?
Yeah, so there are two questions. How much do they cut and when do they cut? And the news so far out of Vienna is they're not cutting yet. Or we'll wait and see what happens from a decision in the Kremlin. On the assumption that they cut starting the second quarter, we don't think that's enough to really reverse things. We think the hit is greater than that. There's been a hit on other things, other moving parts at work. We have U.S. inventories that have built faster and deeper than anyone thought they were going to, and that also weighs on the market, and we'll have a bigger inventory overhang impacting the market. So our take on it is that, yeah, financial flows have been at work. We think the financial flows have been a little bit overly optimistic about a V-fall and a V-shaped recovery, and we think it's really unlikely to be that way. We think the very fact of an inventory build is going to make any recovery a much longer U-shaped recovery going forward.
And all of this also impacting the curve as well as spreads. And one that I wanted to show to you guys is Brent 1 to 12 month. And you can see it really slipped into contango where prices today are cheaper than prices in the future. Regina, when you take a look at something like that and you're a business and you have to make business decisions, how do you do that right now?
Well, I think they have to take the slow and steady wins the race type of an approach. I mean, capital budgets were formulated. As I've said, I think we actually felt like we were achieving a bit of a mini renaissance in Q4 of last year, and you started to see independent oil producers' stock prices come back. This is a significant hit that we're going to take in Q1 and for sure in Q2, but the industry in Houston is optimistic that things will recover, and by the end of Q2, we'll see things stabilize in the mid-50s and perhaps higher or low 60s as we've seen in the past for WTI and Brent.
Ed, do you agree low 60s on a rebound potential or
higher?
Well,
I think that's wishful thinking. I had that wishful thinking myself. I'm waiting for one very critical element of the last quarter results and the year results. What happened to the cost of production globally? In the U.S. and elsewhere. We've seen the cost of production on a dramatic slide since 2014. The last year that we have is really 2018 data. 2018 data showed us that we had average costs of finding and developing oil reaching a peak a couple of years ago at $30 a barrel, and we're at $12 a barrel last year, the year before last. If that doesn't go up, that's really traditionally, historically, econometrically, kind of coincidental with, maybe it's causal with a fair market value of around $45 to $50 a barrel.
Oh,
so
wow.
We think the median price, as it relates to the cost structure of the industry, should be a lot lower than that $60 Wonderland that we and others had been thinking about 2 years ago.
Regina, you want to respond to that?
Well, I hope it's not a wonderland. I can't get into a debate, and it's clearly very steeped in the numbers, but we are more optimistic. We do recognize here in Houston that this is a significant demand destruction event. I think that we will see perhaps a little bit of curtailment of budgets, a continued strong focus on OPEX and OPEX improvements, but we are hoping that demand recovers and that people start to go in and out of China again.
So there's one thing, we talked a lot about demand, so Ed, I want to focus on supply for a second. Libya has the lowest supply right now since 2011. How does that wind up supporting the market if China sort of comes back faster than people think?
Well, it's supporting the market in a way already. The spread between Brent and Dubai has widened, stayed wider. We thought it was going to be wide because of the IMO 2020 very technical specification standards. It didn't really blow out. We have less heavy crude in the market. So yeah, I think Libya has had an impact. It's had an impact on spreads, not on flat price. And on spreads, as you indicated, if it were really going to have an impact, it would keep that Brent structure in backwardation. And it is, as you said, flipped into contango.